July has started off again with a bang, especially on the tech side. And I thought today we could take a deeper dive into what's going on, specifically in the market, in the S&P, relative to some of these big tech companies that we term MAGA, Microsoft, Apple, Google, and Amazon, and how they're really impacting the market, and sort of dig deeper as to what the underlying trends are and how it is affecting both the S&P and the NASDAQ. So perhaps let's start off and give us an overview of what's going on in the last few months with the market, the S&P in particular.
Yeah, if you look under the hood year to date, the S&P 500 is down somewhere around 3% year to date, but the NASDAQ is up around 17%. So a huge divergence. And if you start to look under the hood and you think about the performance of these indexes minus just a few stocks, what you start to see is this trend, even more pronounced version of this trend that we've been seeing since 2017, with the market becoming increasingly narrow in terms of its leadership, and very few stocks representing a disproportionately large portion of these indexes and being responsible for a disproportionately large portion of these indexes' returns. So just to put that into perspective, if you look at, say, the past year, the 1 year trailing period, the S&P 500 is up 7.5%, even though we had the sharpest drawdown since Black Monday 1987. If you take out the 4 top stocks, the MAGA stocks, the S&P 500 is actually flat. All of the returns go away, just those 4 stocks. And this trend has accelerated somewhat in the past year, but this has really been going on for quite some time.
The trend has been in place since probably sometime in mid 2016, 2017, but in the last 6 to 12 months, it's really gone hyperbolic here. I mean, just excessively. So what is the cause of that? Like, why is this happening with those 4 stocks in particular?
There are a confluence of factors. Some more recent. You have, during this pandemic, the Amazon effect, which is really the Sears effect 2.0. So if you go back to when the Spanish flu hit, during the second and third waves of the Spanish flu, the stocks of companies that had mail order catalogs did extremely well. And so the modern day version of a Sears and Montgomery Ward's is Amazon. So Amazon is up 50% because their business has really benefited from this pandemic in many ways. So you have that impact. You look at a business like Microsoft, and so many businesses moving and migrating to a Microsoft Teams platform, and all of that revenue being so sticky as more and more people work from home. So there are those types of factors related to the pandemic that have accelerated this trend more recently. But longer term, we think the biggest factors driving the outperformance of these few stocks have been the rise of passive investing. That has been huge. So the total market share of passive investment products has very recently exceeded the market share of active investment products for the first time in history. That's huge. These stocks represent a huge portion of all the popular indexes, and some less popular indexes. And then also record low interest rates. Those have sort of artificially inflated the value of stocks in general, whose cash flows and earnings are further out into the future. So if you just think, well, the current value of a stock is the present value of all of its future earnings. If your future earnings are way out in the future, 20 years down the line, and interest rates fall, what happens is your present value goes up much more than a company who's making money today. So they disproportionately advantaged by falling interest rates. So confluence of those things.
Those 4 companies in particular have very strong earnings and very strong balance sheets and a lot of cash. And I think the idea of these being staples in a portfolio has become sort of, they're the new fixed income investment to some degree, because everybody's holding them, whether it's in an index fund or just direct ownership. Maybe talk about the flows of money recently in the ETF space, in the index space, and where the bulk of the flows are going.
The flows have definitely favored passive investment products or index products. So as you can see in this chart here, the rise of passive investing. Passive investing has been taking an increasingly large share of investor flows for quite some time, and that their share of investor flows have accelerated quite considerably since about the beginning of 2017. That's sort of why we call these the MAGA stocks, because that's also Make America Great was also the slogan when Trump was elected, and that's when a lot of these trends really accelerated around that time. More of a correlation without necessarily causation. But if you look at the net flows since the beginning of 2017, active products in total, all the active products in Morningstar's universe have had net outflows of $665 billion during a very strong bull market. So the stock market's going up, but active mutual fund managers are getting met with redemptions consistently, versus passive products, a net inflow of over $600 billion. So literally just a rotation out of active and into passive. And if you look just over the past year, for example, and you were to take the top 10 flow capturers, if you will, the top 10 investments that have received the largest net inflows, 9 out of those 10 funds are passive. One of them is active. So in over the past year, those top 10 equity fund flow getters have received inflows of over $112 billion. And a lot of these funds follow various index strategies. You have the QQQ in there, which is market cap weighted, but based on the NASDAQ. A lot of S&P 500 index funds, total stock market index funds, but you even have minimum volatility index funds. You have quality index funds. And what you'll see is this group of 4 stocks, these MAGA stocks, capture about 18% of all the flows that have come into these top 10 fund flows. So you're looking at these 4 stocks have received over 20 billion of that 112 billion just over the past year.
Explain to us the difference between an index fund and an active fund, and really what the base decisions are an investor would make in allocating their capital.
So there are, if you really get into the nitty gritty, you realize there is no such thing as passive investing. And even if you're investing in an index fund and you look at how the index fund is created, you can scratch your head and see that kind of sounds like an active investment strategy. For example, the S&P 500 index fund, any of them, it's a committee that determines the 500 largest companies that can be included in this index. It's not a strict rules-based thing. It's made by committee. And so you read that prospectus and you think, wow, that's kind of an active decision. It's a group of people deciding which companies are going to be included in this index. The traditional index fund strategy is just market cap weighted. So all that means is I'm going to buy the largest stocks in their proportion relative to the total market. So if Microsoft is 5% of the market, 5% of my assets are going to go in Microsoft. And it's very much a momentum strategy that favors larger cap names, because what happens when Microsoft goes up 20, 30%? Well, now it's just a larger weight in the index. The index fund would never sell in that type of an environment. Whereas if you are an active manager and you like Microsoft for certain reasons, you would think, well, I like it, but maybe I don't want to put 5% of my fund in that. And if this stock goes up 30%, I'm going to think about selling because I want to buy low, sell high. The index fund never does that. So in a very basic, on a very basic level, most index fund strategies are just mega cap momentum strategies.
Let's talk about how it impacts other stocks and other markets.
These 4 stocks have a total market cap of over $6 trillion right now. You look at the other stocks in the S&P 500, they're about 20 trillion. And then you take all the mid and small cap stocks in the US equity market, so about 2,500 stocks, and you combine their market caps, they actually have less in total market cap than the 4 largest stocks. Mid and small caps about 5.7 trillion. I mean, another way to think about it is, Japan is the 3rd largest country in the world by GDP, and its GDP is about 5 trillion US dollars. So these 4 stocks are larger than the 3rd largest economy in the world. We've seen it before, where indexes get concentrated like this in a few names, and it normally doesn't end well. But it's certainly getting very, very large and unsustainable.
Right. They become very powerful, as we're seeing sort of some backlash right now against Facebook, who is not in this list, but very close to one of those big stocks. Let's move further into your point about diversification, because the growth indexes, I believe now, according to the SEC, are not diversified.
Yeah, the first thing when you look at this chart, this is the percentage of assets in the S&P 500 that are in the top 10 holdings. So you sum up the 10 largest stocks in the S&P, and what percentage is that of your portfolio? And as we sit here today, it's over 26% of the portfolio is just in 10 names, and about 18% is just in 4 names. So you think you're diversified because you own 500 stocks, thereabouts. But really, the performance of the S&P 500 is disproportionately impacted by the performance of very few stocks and very few sectors. I mean, the rest of the world, for example, looks at the S&P 500 as just a mega cap tech index. We look at it as the market, but very different. Very different. You think about risk differently when you approach it from those two different lenses, right? And so then the SEC ruling, so the Investment Company Act of 1940, the language states that if over 25% of a fund's assets are invested in stocks that each represent 5% or more of the fund, then it's called non-diversified. So if your top 5 stocks are each 5% or more, then it's non-diversified. And that recently happened to growth indexes, because while these 4 stocks represent about 18% of the S&P 500, they represent over 40% of some large growth indexes, the Vanguard Growth Index, for example. And so now, if you go on Vanguard's website and you look at the Vanguard Growth ETF or Index Fund, they have to put a disclaimer, a non-diversification risk disclaimer, saying that they can no longer call this fund a diversified investment option, and its performance can be negatively impacted by the performance of relatively few stocks or a single stock. That has some implications. If the S&P 500 were to get concentrated like that, which we're really not too far away, these 4 stocks represent 18%. The top 5 stocks represent 20% of the S&P 500. So a few more years like this, we could get there. Then you have to think from the perspective of, say, a plan sponsor in a 401k plan. Am I comfortable putting an S&P 500 index fund in this plan, knowing that it's technically a non-diversified investment option?
So in summary, I guess, Mike, we're not picking on these 4 stocks, right? I mean, we're not saying these are bad companies, but we use a lot of these products, and like I said, there are real revenues here. So these are strong companies with great balance sheets. So we're not picking on them, but maybe we're picking more on indexing and passive investing, perhaps.
Yeah, definitely just bringing awareness to the risks involved and understanding that we're at a point that, typically is unsustainable in terms of the concentration in the index and the valuations and the overall size of the top stocks in the index. So there is risk there. Also understanding there are huge tailwinds that could mean this could continue for quite some time. So bringing awareness to this entire issue and understanding it as prudent long-term investors, we have to weigh the risk and reward of these strategies all the time. It may seem like a no-brainer to just invest in the MAGA index or just invest in the S&P 500. But there are plenty of reasons why that might not necessarily be prudent to invest all your portfolio in just these names or all passively at this time. Favoring things like high-quality value stocks that pay dividends, having a portion of your portfolio there, and being aware and monitoring some of these big events that could shift these tailwinds, and being cognizant of those. Those are all things we're dealing with and we're having discussions about on a regular basis.